Hey, what's up, stock compounders? Brad here. So it is that time of the week again, Q&A Thursday. Usually we do this on Friday, but we've had some blockbuster videos this week. A lot of content, a lot of digesting, just a lot of activity happening for me. So wanted to do the Q&A a day earlier this week. So let's roll. Let's dive right in. First question, what thread on corner of Berkshire and Fairfax are you enjoying the most? So corner Berkshire and Fairfax, many of you probably know what that is. It's a message board based in Canada. A couple days ago, I put up a post on there basically asking people, which guru investors they follow, okay? Ideally, a manager that manages less than $500 million. Because that usually managers who manage kind of less than that amount can invest in companies that are smaller than the bigger gurus. And that's, great for me because then I get smaller ideas in the micro cap and the small cap space, which potentially have bigger upsides, right? Pabrai was talking about how he's looking for spawners that have less than 500 million market cap. And there were a number of great responses in that thread. Probably in the next week or so, I'm going to be going through, some of these off the beaten path guru investors, fund managers, and what they've done in the fourth quarter last year, kind of new buys and what positions they've added to for some more interesting ideas. So keep an eye out for that one. Jake, can't wait for this. If you find a potential spawner that is fundamentally rock solid, right? Low debt, high return on equity, return on capital, strong moat, high insider ownership, will you reduce your margin of safety requirements, right? I feel like I may have found one. There's a company in Poland, but it is trading at a price that is a bit higher than I would normally purchase at. With that said, given its strong fundamentals, perhaps a 50% margin of safety is not required. Thoughts? Yeah, this is something I've really been trying to wrap my head around in terms of, at what price makes sense to get into one of these spawners, and at what level is it just too frothy in terms of the price. It's something I've just started thinking about, but, my gut tells me we don't need to insist on such a big margin of safety for these spawners. For these great businesses, our long-term returns, this is something Charlie Munger says, the long-term returns are going to kind of converge on, what the business can generate, the return on invested capital. So it may be a mistake to be super picky about the purchase price. So yeah, I probably wouldn't insist on a large margin of safety like buying the dollar bill for 50 cents. That's really the situation where that margin of safety is critical, right? Because that's the play. You're playing that the market is going to price that company within the next couple of years in alignment with the value that you came up with for the business. But it's a totally different framework to buy a great business and just park your money there. I mean, if you look at a compound growth chart, right? It's that hockey stick, curve that we're looking for. And so if we're talking about the beginning of that hockey stick curve, we can pay a little more, and we're still going to get that exponential growth over time if we buy the right company. So, those are my initial thoughts on it. One exercise I want to do around this, Pabrai put out his 5 spawners in the free lunch portfolio. As an exercise, I'd like to take a look at these 5 and just try to get a sense, all right, which one, how do I value them, first of all, from like a long-term compound growth perspective? And how would I compare these 5 to each other from that perspective of holding them for decades? So, I'm going to challenge myself to that thought exercise. You know, this is something I want to wrap my head around much more. And if any of you have thoughts about this, you know, how do you decide when a spawner is appropriately priced and if it's just too richly priced? I'd love to hear from you guys on that. If I may sneak in a second question, well, we're going to get to your second question first. So there you have it. What are your thoughts on Pabrai reducing his Shinnikin stake after beating up the stock in a few interviews? Right, so Pabrai, I don't think he's ever specifically mentioned Shinnikin. I have pretty high conviction that the Japanese company he's been talking about as a spawner is Shinnikin. So let's take a quick peek at that in a ticker terminal, just so you guys, we're going to actually look at Pabrai's international portfolio. That's going to be the way to look at that. Pabrai investment funds. So we see down here at the bottom, Shinnikin, okay? Change in shares, 13.2%. Is that right? So it's showing that he actually added 13.2% to his Shinnikin position. A couple days ago when I looked at this, it showed that he had sold some off. So I don't know if that was an error with ticker terminal. But regardless, let's assume he did sell a little bit off. One of the things Pabrai said in a recent talk, there's really only one reason an investor buys a company, right? They're bullish on that company. There's 100 reasons for an investor to sell a company. So, you know, even if Pabrai had sold off a little bit of Shinnikin, that doesn't necessarily mean that his thesis on it has changed or that he's less bullish on it. Obviously, we don't love to see that, especially if it's a company that we're looking at or own. But it appears maybe there was a mistake, and that has been corrected in ticker terminal. That's interesting. I did not expect to see that right now. So I think he's probably still very bullish on that company. David, you recently mentioned being interested in a lithium play because of electric vehicle industry growth. Why lithium as opposed to other commodities? Or was there a particular mode or aspect of a particular business that was especially appealing? Great question. Yes, I have been very interested in particularly mining companies that are mining these metals that we're really going to need to fuel the transition to electric vehicles, to, you know, renewable energy sources, wind energy, solar energy. There's a lot of metals that are required for that. Lithium being one of them, copper, nickel. So it's something, you know, I'm just learning about it. It's not something I'm an expert in at all. But I did buy a small stake in Lithium Americas Corporation, which I think there's another question about that, so I'll talk about it then. But it's not lithium in particular that I'm interested in. I'm still figuring out, all right, what are going to be these metals that are in the highest demand? Sorry, guys, I'm just going to reboot the video here. What are the metals going to be that are going to be in the highest demand? And then if I can find a great business that's, you know, in the business of mining those particular metals, you know, that's when I'm going to go deeper into that particular business. So it really has to fit both of those buckets. So that should answer that one. Can you do a 13F video on Rule 1 fund for Q4? So this is about Phil Town's Rule 1 portfolio. Absolutely. Guys, I expected Phil to release his holdings at the end of January. And I've been checking quite frequently in the World Funds Trust SEC filings, and I have not seen Rule 1 there yet. So this is at the top of my list of videos to make. I just don't have the information yet to make that video. Investing with Frank asks, Do you consider or actively seek operating leverage when investing? Monster Beverage is probably the best example of how beneficial it can be, which Chris Meyer discussed in his book 100 Baggers. Razor had clear signs of operating leverage, and I passed due to some corporate governance concerns. I have underestimated it in the past, meaning operating leverage, but now I am actively looking for operating leverage. So let's just give an overview of what operating leverage is, okay? And whenever you guys don't understand an investing term, Investopedia is a fantastic resource. So what is operating leverage? It is not the same as financial leverage. Operating leverage is an indication of how a company's costs are structured and is used to determine the break-even point for a company. Break-even point is where the revenue from sales covers both the fixed and the variable costs of production. Okay, that's a key point. You have fixed costs and you have variable costs. Financial leverage refers to the amount of debt used to finance the operations of a company, right? So financial leverage is money the company is borrowing. Operating leverage is how the fixed costs of operations compare to the variable costs of operations. So operating leverage measures the extent to which a company or specific project requires some aggregate of fixed and variable costs. Fixed costs are those that do not fluctuate regardless of the number of sales generated. Okay, so these are some examples of fixed costs. The company can sell more goods, they can sell less goods. It does not change these fixed costs. Variable costs vary in direct relationship to a company's production. Variable costs rise when production increases and fall when production decreases. Okay, so the point here, the important point about operating leverage, a company with high operating leverage has a higher percentage of their total costs as fixed costs. Companies with low operating leverage have a lower percentage of their total costs as fixed costs. So what Frank was pointing out here is he's more and more interested in companies with high operating leverage, a higher percentage of costs in the fixed bucket versus the variable bucket. Now, the issue I see with that is if the company has trouble, right? If the company runs into trouble, say there's a recession or something like that. I mean, you can think of Fiat Chrysler, right? Any car company. What happens in a recession? Sales plummet, but they still have these really high fixed costs, right? They still have the plants. You know, it's really hard for these companies to lay off employees, so that can take some time. You've got all of those salaries. So high fixed costs can be dangerous during some kind of a downturn or a time when a company is struggling. So there's risk there. But on the other side, if things are going great and the company is really scaling up revenue, really scaling up sales, it can be awesome for investors in that company because of that high operating leverage. And to be honest, I don't think consciously too much about operating leverage. Maybe I'll think about it more now, just because it's been raised to the surface. But it's not something that I particularly am searching for. And it seems like it's hard to find screeners that let you kind of sort by operating leverage, but maybe I'm just not looking at the right platforms for that. So if any of you look for operating leverage in particular, let me know which screeners you like for that. What are your thoughts on Buffett selling some Apple and Lilu buying some? I'm not surprised that Buffett is trimming his position in Apple. Trimming might be the wrong word. Taking some money off the table for deploying elsewhere. To me, Apple seems frothy, but at the same time, it's an incredible business. One of the best businesses in the world. Very sticky. I mean, I'm thinking about upgrading my iPhone right now as we speak, and these things aren't cheap. So I'm recording this on a MacBook Air, right? If I compare the MacBook Air to a a Windows computer that has the same kind of functionality. I paid a lot more for this MacBook Air, right? For the same kind of basic product. So incredible brand for Apple. Again, it didn't surprise me that Buffett sold a little. It really surprised me that Li Lu bought some. I mentioned that in the Guru, High Conviction Guru Stocks video. It was hard for me to wrap my mind around that. I still don't understand it, but it's Li Lu. So rather than just assuming, Li Lu has FOMO or something like that, right? There may be something there to dig deeper into. I don't think there's an investor out there that I respect more than Li Lu. So it was unexpected. How many stocks do you have in your portfolio, and are you actively trying to keep it at a certain amount, like 10 or so? Yeah, I really only have 2 what I would consider like full positions in my portfolio. And those are both like 20% bets at the moment. Now I have the Magic Formula kind of bucket portfolio that I'm testing. Those are a smaller allocation. There's 15 in there right now. 10 is probably too many for me in terms of my high conviction bets. Somewhere between 5 and 10. Let's say 8. I'd be very happy to have kind of 8 bets at around 12% each, something like that on a cost basis. But depends how much I like them. Depends how firmly convicted I am. If I'm all in on a handful of stocks, I'm pretty comfortable with that. So somewhere between 5 and 10. I would be interested to know more about the valuation methods you use when a company isn't profitable yet. This is often the case with recent IPOs, less than 5 years. I know that most value investors focus on companies with strong fundamentals, but this doesn't necessarily mean we shouldn't check for bargains in more recent companies. Yeah, it's a good question. So I don't have any. Well, how should I say this? So companies that have less than 5 years of history. First of all, I think most IPOs probably have more than 5 years of history, unless you're getting into some of the SPACs. Those sometimes don't. But it's really hard for me to get interested in a company that has such a short history, especially a company that isn't profitable yet. Like I could pretty much say I'm not interested in a company that's not profitable yet. The difference between a company that's losing money and a company that has, a really strong balance sheet, you guys, there is such a delta there. It is so hard. If you look at the number of companies that have gone from unprofitability to, one of these long-term compounders, it is minuscule. So yeah, it's hard to value. I mean, I guess what you do is you just project cash flows out as far as you comfortably can, and then discount those to today. Damodaran did that with Uber, I think, back when it was still unprofitable, and so you can do it. There's just it requires a lot more faith, right? These projections forward, you don't have this kind of successful, profitable history to extrapolate forward. So, for most investors, I would say stay away from those. Where do you go to find Guru Investors International holdings? Right, his 13F, Pabrais 13F only shows 2 holdings. So ticker terminal. Okay, if you guys want to get in here, I can send you a sign-up link. It's in the beta version. I don't get anything at the moment for sharing this sign-up link, so no skin in the game for me. But Yeah, you just go to Track Gurus, and then you can click on, let's say, Michael Burry, right? And we can see his largest equity holding is this company in South Korea, Autech, okay? And that was from not a 13F, as you can see here, but a shareholder report. So, and then for Japanese companies, you've got these Japan 5% filings, where if an investor owns more than 5% of the shares outstanding, they're required to disclose that somehow. So, fantastic site, Ticker Terminal. So let me know if you want that. Hit me up in the comments. TechnipFMC announced a couple days ago they have completed their split into 2 separate publicly traded companies. That's exciting. Since that announcement, FTI has taken a nosedive, and the counterpart has had a nice little run-up. My question to you is, how do you make sense of this, and how would you move forward as an investor? Well, I haven't looked at these, but possible reasons for this. So maybe FTI, you know, it was the smaller portion of the split, and it had a market cap that was too low for a lot of these institutional holders that were holding this kind of original parent company, which could cause forced selling on the part of institutional owners. Maybe, you know, the company had a lot of debt and it stuck the debt with FTI. I don't know. I'd have to look at it more specifically, but could be interesting. You know, whenever a split happens and one of the pieces takes a nosedive, it's worthwhile to understand why it took a nosedive. And probably the first place I would go to learn more about that is corner of Berkshire and Fairfax, and I would just search FTI or TechnipFMC, and you can see if anyone has kind of posted that as an investment idea and if there's some conversation about that. Really smart investors in there. So, you know, it's an awesome resource. While I share the excitement of Monish's recent pivot towards spawners, the thought occurred that this is a new type of investment class that he is pursuing. With that, wouldn't it stand to reason that his successful hit rate will decrease? Moving from 50-cent dollars to spawners is a significant leap. Would be interested in your thoughts. Yeah, I have a few thoughts about this. So my first thought, back in the 1990s, Pabrai ran an IT services business. Okay, he started and ran this business for 10 years. And with this business, he actually engaged in spawning, right? Adjacent spawning. So he understands, you know, the spawner framework as a business owner. So, you know, he's got that going for him. Another point I want to make, so Nick Sleep, right? You guys, most of you have heard of Nick Sleep. Pabrai's been talking about him a lot. Nick Sleep, you know, a UK, an investor in the UK from like 2000 to 2013. He basically had 3 positions that accounted for 90% of the portfolio. By the time the fund got shut down, or by the time Nick Sleep closed the fund in 2013, Amazon was 60% of the portfolio. Another example, Pabrai, when he started investing, he invested from like 1995 on his own, from 1995 to 2000, okay, before he started his fund. He basically had 10 positions, okay, at $100,000 each. Now, one of those went from $100,000 to, I think it was $10 million. So it was a 100-bagger, okay, 100,000 to 10 million. Now, if you have a hit rate of 1 out of 10, and you get a 100-bagger like Pabrai did back in the late 90s, all you need is a hit rate of 1, okay? Same with Nick Sleep. All he needed was Amazon to hit, and that, you know, drove the returns of the fund. So, yeah, his hit rate might decrease. You know, I don't know what his hit rate was with the 50-cent dollar bills, maybe 50%, 60%, something like that. But with this strategy, his hit rate can dramatically decrease, and I think he can still do very well. So that's how I would answer that. Sharing some psychological misjudgments that I am guilty of when investing. I'm guilty of these as well. Wanted to get your thoughts, whether you face them, and if you do, any recommendations to counter them. So first one, sunk cost bias. You spend days doing research on a company, which from the outcome of your analysis, you know it's a wonderful business, but end up paying a much higher price than you like since you already have spent so much time researching it. Yeah, this is a very common problem. It's why Pabri's talk at Google, I think, was called serious, something like intense investment research can be injurious to your financial health because of this, sunk cost bias. It's a tough one. I think one way to combat this is to stay as rational as possible by trying as hard as you can to come up with the inverted story for a company that you already like from the get-go, okay? Talk to really smart people who are short the company or don't like the company. So that can help you kind of stay rational if you've got kind of both sides playing at the same time. But yeah, it's a tough one. At the end of the day, it might be worthwhile to have some quantitative framework for deciding, at what price you're willing to go into a business to remove some of this compulsion to pay more than you should be for companies that you really like. I don't have that quantitative framework, but maybe it would be helpful. Number 2, anchoring bias. Bought a first tranche into a business, reluctant to pay to continue building your position as your mind anchors around the initial purchase price. So this happens to me all the time, guys. Yeah. So one trick, one of my common frequent commenters and someone I'm connected to on Twitter sent me a message. He basically said, he's having the same conversation with the fund manager, and the fund manager doesn't keep track of his initial purchase price. All right, and the reason for that is because then, he can look at the company kind of with fresh eyes, decide what he thinks it's worth based on what that business is doing in real time, to try to avoid this issue of anchoring to some initial purchase price. So I thought that was interesting. But it's a tough problem. I guess one way to think about it, great businesses like Google, for example. Look at the price history of Google. Look at the track record of great businesses, these great long-term compounders. And you can see, say 10 years ago, if you looked at the metrics of the business, you might have thought, wow, that seemed expensive, but how would my returns have been over the last 10 years? You can go through some of those exercises to convince yourself, maybe I don't need to penny pinch at the beginning as much as we're used to. Okay, next one. Do you vote in shareholders meetings or through proxy? I wonder what the impact of this in having an owner's mindset as a shareholder. So I've never voted at a shareholders meeting. I consider myself more of a passive investor in that sense, versus like an activist investor or something like that. It's not just, it's just how kind of I see myself in terms of a business owner. I want to buy a business, and then I want to kind of be hands-off, let the management team and the employees do their thing, right, to make me money as an equity holder in that business. Why did you invest in LAC? Isn't downside too big? So again, this is about Lithium Americas Corp. I opened kind of a teaser position in Lithium Americas Corp. I wouldn't say I invested. It was more just to, get me to think like a business owner in that business, get me to go deeper, kind of motivate me to really go deep, understand the business a lot better. And it was really an idea I got from Massif Capital, MASSIF. It's kind of a boutique investment fund. I think maybe 3 to 5 million assets under management, but really big in the decarbonization space, in this transition from a high carbon economy to kind of a renewable based, low carbon economy. And you can read their write-up. If you go to Massif Capital, look at investment reports, you can download their, I think it's like a 15 or 20 page write-up on LAC. And I'm curious, Thomas, if you want to follow up why you think the downside is too big. If you look at a price chart of LAC, the thing has just gone gangbusters. I think it was in the couple dollars per share within the last couple of years. And now it's up at like $20 per share. So, if you just look at the price chart, you might think, wow, look at this huge downside. But that's not really how I'm looking at it. I think the business has improved a lot over the last couple of years, and it's really a different business now than it was back when it was a couple dollars a share. But again, I'm just digging deeper into it. I want to better understand lithium. I want to better understand kind of the metals mining space, not just lithium, but some of these other essential metals. So just a teaser position to wet my beak. If you're a Berkshire Hathaway shareholder, is it silly to copy their investments released or shown in the 13F filings? I don't think so. I mean, there's a lot more to Berkshire than their public companies, right? They've got private companies. They've got a bunch of cash. I'm sure they have a lot more than that. I haven't gone deep on Berkshire, at least not recently. But I don't see any issue with owning Berkshire Hathaway and owning, directly a couple of public companies that Berkshire Hathaway also owns. I don't see any problem with that at all. So, yeah, to me they're different. They're very different kind of investments. And I think one I'm going to look into is Verizon, which I think was the biggest purchase in the fourth quarter for Berkshire Hathaway, at least in the public company realm. And it's a pretty interesting 4.5% dividend yield, and seems like a very strong moat. I mean, I'm a Verizon customer. I don't particularly love Verizon as a business. They feel like a monopoly to me, like I don't have much leverage as a consumer, as a customer of that business. But it works. I generally have the cell service that I need, but I pay them a lot of money every month. My whole family, I'm on a family plan, and it's like a couple $100 each month. So, but that's a compelling business model, right? That's that recurring revenue business model. That's kind of the holy grail of these long-term compounders. I just wish I would have found Verizon back when it was, less than 5 billion. I think it's a couple $100 billion at this point in terms of market cap. So I don't think I'll invest in it, but in fact, I know I won't invest in it. But for a lot of people, especially people who need their investments to produce some kind of income, Verizon could be very interesting to look at. Same with AT&T. I was seeing in corner of Berkshire and Fairfax, some compelling arguments for AT&T. I think it has like a 7 or 8% dividend yield, which is kind of insane. All right, guys, my voice is starting to go, and we're through the questions. So we will conclude this Q&A session. Again, I'm doing this every week, so keep an eye out for these Q&A posts. I'm loving the questions, guys. Keep them coming for next week. And with that, I will see you all in the next video. Take care.